Ladies and gentlemen, this is what Tom Lee just said about our market. And there's really two things to point out here. Number one, he says the BLS comment that Beryl had no discernible impact on the jobs data defies logic. The fact is 1.3 million homes and businesses were without power for 2 weeks. The August jobs report should be the counter to this and show a major upside surprise. But more importantly than that, Fundstrat's Tom Lee says the VIX with a 3-day ROC of 65+% typically is near the end of a risk-off event. The S&P 500 is higher 6 months later, 88% of the time, with a median gain of 8%. Unfortunately, I don't think this will be correct, and I think there's some context you need to know. Because yes, Tom Lee is correct, and when the VIX spikes like this, you do tend to see that that's the end of a major event or of a just major sell-off. But unfortunately, context is key because the VIX measures or monitors puts and calls on the S&P. Okay, the VIX has been artificially low for a very long time. Really, the last 12 months. You did see a VIX spike back in April, but you've been low for a very long time on the VIX, like 12, 13, at some points 11 on the VIX. Very, very low. That means there was not a lot of puts and there was a lot of calls. What happened is the markets were just jolted, right, or shocked by this series of events that we've seen over the past week or so. And everyone rushed to sell out of calls and buy puts. So the VIX was in a very low place, and you've seen a massive influx of puts. You really didn't see anything get better, right? This usually when you see the VIX spike and go down, and you have a good next 6 months. It's usually like after the Fed is intervening, after, the Rona for that matter. This was just really spiked because there was not a lot of puts on our market, right? A historically low amount of puts on our markets. And you really just normalized things. You got people a little bit more defensive. That's why the VIX spiked so much, because the ratios of puts to calls was so low. And now it's just getting back to normal level, right? I will admit a little bit more than normal. There was some fear last week, but I actually do think you're probably in for quite a bounce this week. Because there's not as much new information that we will get this week. Starting off with your economic calendar. Actually, tomorrow morning, you will get the biggest set of data for this week. Now, Thursday will also be an important day, and we'll look at that in just a moment. But you will get ISM Services PMI. Now, services has really been the strong area of this economy for so long. Manufacturing's been in the toilet, real estate's been in the toilet, different areas of the economy have just been bad for years. Services has really held things together. Now, last month, you did see ISM Services go through a surprise downside move. You actually went into contraction for the first time in a very long time. Services really do not ever contract. And you came in at 48.8. Anything under 50 is contraction. So you're expecting a number of 51. So you're expecting positive growth again for ISM Services PMIs. ISM Services business activity came in at 49.6 last month, expecting 50.9, so back into positive territory there as well. ISM Services employment is expected at 46.5. Last month, you were at 46.1, so a little bit of an improvement there. ISM new orders last month came in at 47.3. We are expecting 49, so some improvement there as well. And ISM Services prices came in at 56.3 last month. We are expecting 55.8, so actually a step down in ISM Services prices, and that would be the best case scenario. If services activity picks up and prices start to fall, that would be good news for the economy and disinflationary news for prices in the service sector. Fed Daily will be speaking at 4 p.m. She has been a little bit more on the hawk side recently, so we'll see what she thinks about this newfound information in regards to the labor market. Now, on Tuesday, you will get the balance of trade, expecting negative $72 billion, exports and imports, expecting exports at 268 billion, imports at 340 billion. This will move the Atlanta Fed GDP estimate for Q3 GDP. So currently you have an estimate of 2.5% per the Atlanta Fed GDP Now tracker. The average blue chip consensus by Wall Street and economists is about 1.8% for Q3 GDP. This is going to be really the first big update that we will get for this GDP estimate based on the exports and imports data on Tuesday, August 6th. So that will be important because, I mean, exports, imports have a very large impact on your GDP estimates. Now, Tuesday as well, you will get the Economic Optimism Index, expecting that to actually go up from 44.2 to 45. And as I have said before here on this channel, I don't think the Fed matters. I don't think inflation matters to the extent of causing new all-time highs or, further lows. Like, are we really going to be that excited if inflation comes in lower than expected again? Because we're basically already in deflation or pretty close to deflation territory. I think inflation is dead at this point. And the markets, they're just not going to react to super low or better than expected inflation to the same degree as we have in the past, at least. Could you have good days based on good inflation numbers? Of course. But I don't think that's really a catalyst to send us back to new all-time highs at this point. The Fed, even for that matter, I don't think the Fed's much of a catalyst as well because, I mean, we are already expecting 50 basis points in September, 50 basis points in November, and 25 basis points in December, according to JP Morgan and Citibank. So is that really going to be a catalyst? I don't think so. It's all about the economy from this point forward. The better the economy, the better the markets will be. Okay. And then on Tuesday as well at 11 o'clock in the morning, you will get total household debt. Last we had was $17.7 trillion. Although I don't think the markets will react to that. That will be an interesting point to keep in mind. Now, on Wednesday, you will get a 10-year bond auction at 1 p.m. And that's really one of the only bits of new information we will get on Wednesday. You also have consumer credit change, expecting that to go up by about $10 billion. But normally, that doesn't move the markets too much. On Thursday, initial jobless claims are expected to actually go higher again from 249,000 last week to 250,000 in this upcoming week. And continuing jobless claims is also expected to go up by about 3,000. So you want to watch this. If you start to get closer to like 280,000, 300,000, that's more where we are usually at heading into recessions. So initial jobless claims each and every single week will be now an important catalyst for markets. You also get Fed Barkin that speaks at about 2 p.m. on Thursday. So we'll see what he has to say. And then on Friday, you really don't have much of anything. You have the unemployment rate out of Canada, likely, not going to move our markets, but hey, we'll see. We do have quite a bit of earnings as well still this week, and I want you guys to think about specific sectors, right? So these companies reporting will affect their certain sectors, like Palantir that reports Monday and after hours. That's going to affect software, potentially a little bit of that cybersecurity, although the Palantir really doesn't do that. You could kind of see a sympathy reaction in that area. You also have Him and Hers, Clover, Lucid, Realty Income, Avis Budget Group, Teradata, CSX, and Zoom Info, as well as Simon Property Group, Monday and after hours. Tuesday pre-market, Uber, Celsius, Fubo, Caterpillar, ATI, Constellation, Clear, and Marathon. Tuesday and after hours, I think this is going to be your biggest earnings as far as affecting the broader markets, and that is Supermicro. right? Because NVIDIA still has not reported, and Supermicro and NVIDIA go like hand in hand. They do a lot of business together. So Supermicro definitely will be a big one for this upcoming week. You also have Rivian, Airbnb, Wynn Resorts, Devon Energy, Reddit, Axon, Upstart, and Amgen that report Tuesday and after hours. Wednesday pre-market, Shopify, Walt Disney, Novo Nordisk, CVS Health, Global Payments, Emerson, Aora, Lyft, Sony, and Dynatrace. Wednesday and after hours, Robinhood, Magnite, AppLovin, Digital Turbine, HubSpot, Oxy, Energy Transfer, and Dutch Bros. Thursday pre-market, Eli Lilly, Vistra Energy, Plug Power, Datadog, Novavax, Chrono Group, CyberArk, and a couple of others. Thursday after hours, SoundHound, Elf, Unity, Paramount, The Trade Desk, Array Technologies, CleanSpark, and Jinko Bioworks. And then Friday pre-market, Canopy Growth, Nikola, New Fortress Energy, and some others like AMC Networks and Embecta, as well as Legend Biotech. So again, think certain sectors here. Shopify, that could affect Amazon, that could affect, other maybe online retailers for that matter. Supermicro is going to affect your semiconductors quite a bit, as well as the broader market. Uber, Palantir, Walt Disney, Novo Nordisk. Think about the sectors here for this week. Datadog, for that matter, because a lot of these companies they're not going to move the broader index. They're not going to move big tech, but their certain sectors could definitely be impacted. Some of the biggest news coming out here in about the last 12 hours or so is this. U.S. and Israeli officials warn of expected Iranian attack on Monday, and you can see Israel's Prime Minister Netanyahu warns of high costs for enemies in the event of an attack on Israel. Netanyahu also warns of Iran and its proxies attempting to surround Israel on 7 fronts. This is according to just 1 hour ago. Israel's ground and air defense readiness is high, and Israel is ready to swiftly respond to attacks. So we've seen in the past when you get this kind of back and forth there with Israel and Iran, or Hamas or Hezbollah for that matter, it can affect the markets in the very near term when the news does come out. We've seen a little bit of that last week when Israel attacked the general, I think, of Hamas in Iran itself. Like, there is sometimes a short-term reaction to that. We've seen that on one of those very red days. It caused more selling. But if it continues to affect the markets or not, really comes down to is there this back and forth, right? If Iran attacks Israel and perhaps Israel attacks back, that's problematic. But if Iran attacks back again, that's where you're going to blow up some of those World War III fears and potentially see outflows to stocks, inflows to bonds, potentially inflows to gold and other related assets. Even Bitcoin could potentially benefit if we do see Middle East tensions ramp up further. Although that's just something to watch for, it could be a negative for markets. I don't think that is a huge deal at this point in time, at least for equities. CNN's Fear and Greed indicator is sitting at 27, which is in the bottom end range of fear. So I definitely think there's some room for things to get a little bit less fearful this week and to see a little bit more of a bounce. After all, the latest AI investor sentiment survey that we have shows bullish investors at 44.9%, neutral investors at 29.9%, and bearish investors at 25.2%. And again, given just we have most of your big tech earnings out the way, at least until NVIDIA. We got a lot of data last week. I think you're probably going to see a bounce this week. Now, you bounced at that 100-day moving average at about $528 per share. I am expecting a bounce up to this 50-day moving average around $543. So I think you have about $10 or so, give or take, of upside in the S&P, likely in this upcoming week. Now, do I think you're going to rally much higher than the 50-day moving average? Probably not. Not until the economy looks like it's actually getting stronger. ISM services would likely be the reason for a bounce, as long as that does come in good. And I think the odds are we do bounce this week. But again, do not forget what I said in some of the last videos. We are going into a recession. It will happen. The data will get worse. The markets will go lower. You want to take this opportunity to raise as much cash as you possibly can. Cut back expenses. Get more money available to you, whether that's credit or, money out of your home or whatever it is. Just mowing lawns on the weekend, doing side jobs. I don't care. You just want to get as much cash as possible ready to go shopping when markets do really fall. For that matter, I think real estate will also fall, because if people start to lose their jobs, then, that puts pressure on real estate. And, I think a lot of people would benefit from being ready to go shopping in real estate to be able to maybe get a rental or get a different home as well. So I think cash is king right now for at least the next 6 to 12 months. That's when I would expect. By then, 12 months from now, we're going to be likely substantially lower. Maybe in 6 months, maybe in 3 months. Who knows? There's going to be election volatility as well. But I think right now is time to prepare aggressively for larger downside, for what could be generational buy the dip opportunity, because I think after this, mini recession or whatever we do go through, it's going to be a raging bull market for a long time. So with that said, guys, that is going to go ahead and conclude this video. Let me know what you think about this down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. And if you made it to the end of this video, it is free 99 to do so. It costs you nothing at all. Enjoy your day, the rest of your weekend, and I will see you in the next one.